Good morning and welcome back to Almus Market Mornings. Just like Friday's employment report moved the expectations for a rate hike, today's CPI from the US is an equally big mover. The Fed has a dual mandate, inflation and employment, hence the reaction was significant when in the face of broadly higher inflation, employment came in weak. This gave confidence to markets that the Fed might stay put in such kind of situations. And now, of course, the focus would be on CPI, which previously was in a decline after energy prices had broadly fallen. So, from that base, the general market expectation now is that it will grow by 0.1% month on month. Good morning, JK. What's your expectation from the US CPI today? And do you think this can be a market mover?
Good morning, Swaraj. So actually, this is a week of inflation indicators from major economies. And of course, the focus will be mainly on US inflation. And hope is that the inflation, which moderated last month, will continue to sustain lower so that Fed will not have to hurry into a rate hike. That's in fact, what the market is looking for. Uh, the US CPI is expected to rise by 0.1% in July. As energy prices somewhat stayed lower only, but higher than what it was in June. Core CPI is expected to rise by 0.2% after being flat in June, and some recovery in shelter and hospitality prices are also expected. But in US, for the bond market at least, it's not just the CPI or the PPI, it's also the fiscal deficit number that will be declared or rather published today. So the deficit for fiscal year 2020, tariff collection, etc. However, with the tariff refund that's happened in May and June, the 2026 fiscal deficit is running well above 2025. And some estimates suggest that it will be going up to 2.1 trillion deficit for this year. And July number will be published today, and bond market will be focused on this also equally, if not more, than what the CPI number indicates. Of course, CPI number will also see the Fed getting more input. They will have one more CPI number before they meet next in September. So I think that's where the market's assessment of Fed's reaction function to the inflation will be seen. Yes, and for the bond market, of course, fiscal deficit number will also be very important. Staying on inflation, of course, yesterday China's inflation also fell to 0.5% year on year, down from 1% in June. This again, the deflationary forces in China is in play. This is despite the oil prices, global oil prices remaining high, and this is the 6-month low in inflation. So the Chinese inflation trend is still very subdued, and a further fall may again call for monetary easing by the Chinese government. We'll have the UK inflation and also the Eurozone inflation final numbers this week. All of them contributing to the bond market volatility, perhaps. And then we have the Indian consumer inflation today, expected to have risen to 4.5% from 4.38% that was seen in June. This is the second month in succession we have more than 4% the medium target, or rather the median target. Two reasons: food inflations have edged higher as concern about monsoon rises. Though July did make up some part of the monsoon deficit, it was not enough to bring down the prices. And of course, the oil prices in globally have again touched 90, and any rise above 100 will bring back fears of retail prices of petrol and diesel being raised. So these are the factors that the market will be focusing on, not just the today's number, but what's going ahead for the food prices due to monsoon, as well as the global crude oil prices. These are the two things that the market will be looking at. The core inflation, of course, remains subdued at 4.08%. Then, of course, on the Iranian side, we have there is some Iranian leadership changes that has happened, where the Khomeini has induced certain leaders from the Iranian militant group, Iranian, IRGC. Uh, then they are hardliners who are controlling key security decisions, and that means uh, very unlikely we'll have a compromise from them over the Strait of Hormuz. As talks also remain stalled, and alternate Gulf export routes also face the risks, as we have shared, the Saudi Arabian exports being affected. The oil market's geopolitical premium is not likely to disappear soon. So the situation remains fragile, and this is one factor which will continue to contribute to the inflation figures. Uh, we have, of course, the markets waiting on its hands to get some more clues on the price pressures and what it indicates for the monetary policy. So not much movement in the stocks yesterday, some correction in S&P 500 and the Nasdaq. Uh, the bond prices have retreated initially, and then again have come back up, anticipating the fiscal pressures to keep the long end, offered as far as the bond prices are concerned. And the dollar is again, particularly against majors, there's a divergent movements. Yen continues to weaken. Now we are pushing towards 159.50 as well. No sign of intervention, not even uh, verbal intervention from Bank of Japan officials. It's very important. The credibility of their actions is on the line if it crosses 160 and stays there. Because why we are speaking of credibility is this time even the US had joined the intervention. So that's something that we look ahead to. And of course, euro remains very much range bound. Commodity currencies are doing good, Australian and Canadian dollar, even as the commodities rally. Copper had a big rally, and gold, silver also, as we shared yesterday, have seen very good recovery from their recent lows as well. I don't think we see much of a movement as far as uh, the currencies are concerned. We should see them in a range until at least the inflation numbers and the fiscal numbers are announced. As far as Indian rupee, again, range bound, slight weakness seen, but nothing significant. What is significant is that the bonds on the INR, across tenors, 1 month to 1 year, have significantly come down. About 50% also what it was back in April at the peak of the US-Iran conflict. Now we are at, for 1 month, we are at 4.55% as against 8.78% back then. So this indicates expectation of large moves having receded, particularly for the weaker side of the INR. But at the same time, lower wall levels also indicates that there can be a sudden trigger of, or rather a burst of moves as corporates find it cheaper to buy protection. This, of course, can happen on either side. So the lower the walls go, the more chances that we'll have a sudden burst of volatility. It indicates currently less volatility, but possibly indicates a future volatility increasing. So that is the calm situation that we are seeing ahead of key inflation numbers from US and Iran, and definitely should be seeing much more moves in the coming sessions. Thank you.
Thank you, Jagan. Yes, calm before the storm. We have got the CPI print from US, India today, and also the fiscal deficit numbers from the US, which will be keenly watched by the bond markets. Apart from that, it's a week of inflation numbers. All major regions are reporting their inflation figures. Even UK and EU later this week. China, we have already discussed some deflationary forces in play, despite the oil prices remaining so elevated. That would be the focus. Likely currencies would be in a range to at least till the inflation figures, and that is we'll pick it up from there tomorrow. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.